Thanks so much for tuning into this earnings conversation with Mphasis. IT has been a difficult sector to track this quarter. There are a remote few companies which have posted very strong numbers relative to what was estimated, and there are few which have disappointed. And then there are few like Mphasis which has come out with a flattish quarter because of opposing forces at play. Let me get in the management to try and tell us what went in the half or in the quarter in the first half, and what does this mean for the full year. Nitin, Rakesh, Manish, Dugar, join in. Gentlemen, thanks for taking the time out. What went behind the quarter, Nitin?
I think, as you pointed out, Neeraj, there are countervailing forces at play. I think there are some segments of the business that still continue to face the macro-driven headwinds. We've had a mixed bag over the last couple of quarters. We had record TCV wins last quarter. First half of the year, we are up almost 60% YOY in terms of our TCV wins. So the pipeline, creation closure definitely seems to have improved over the last couple of quarters. Revenue conversion still lagging behind where we think it needs to be. So that's one thing to think about. Second, I think BFS macro headwind still continues to persist, both in terms of an overhang from the regional banking crisis, as well as tightening of discretionary spends with an expectation that the interest rate environment will lead to a worsening consumer environment in the US at least. So that segment has been also challenging. We also had a double, whammy effect there over the last few quarters, given the exposure we've had to the mortgage business over the last 4 or 5 quarters. That segment was declining. We've seen moderation of that decline over the last 2 quarters, and I think we're at a point where, given just our wallet share gains and order book situation, we think that's behind us as well. The non-BFS business has definitely grown well for us, especially high tech, travel, and healthcare. So I think that has definitely, made up for whatever headwinds we saw on the other side of the other half of the business. So I think we are pleased with the fact that we've shown sequential growth 0.7%. We're also very pleased with the fact that our first half order book is strong, and we do believe that the worst seems like it's behind us, and we should see uptick in growth sequentially, potentially Q3 accelerating into growth in Q4 as we stand. Of course, still too much uncertainty out there in the macro environment on the geopolitical front as well. So it's hard to kind of call a bottom, but we are cautiously optimistic based on purely the order book as well as the TCV wins that we've had in the last 2 quarters.
Nitin, if Jay Powell as well as some of the other influential bankers are to be believed, it might need to engineer a recession, if you will, in order to keep inflation lower. And if that is the principal target, what does that mean for business? Because we're waiting for rates to come off, for sentiment to improve, so on and so forth. But if it will take an engineer to, it take a recession to get that going, could that mean that the other parts of the business get impacted negatively?
Yeah, I think we are still waiting for the recession we were promised, and the uncertainty is what drives a lot of the pause and creates inaction. Once we know that we are in recession, then we know that the beginning of the end is visible. So I think the sentiment actually might improve counterintuitively as we actually see that happen, because as both the markets and of course the buyer behavior starts to think about what happens next, not what we are in today. Unfortunately, we are in the same frozen state for the last 6 quarters since the first tightening started happening in March of 2022. So I think, to me, uncertainty creates inaction is kind of the phase we need to get out of. As I said, instead of waiting for the macro to improve, our focus really has been on a bottoms-up, account by account, micro strategy, segment by segment, vertical by vertical, geography by geography. So I think we kind of switched into that mode over the last few quarters, because we definitely can't control what's going on outside our control. And even the best of the estimates from any economist or central banker are at best, I think, a guesstimate. So at this point, hard to kind of take a macro call. I think focus more is on what segments can we control, how can we continue to build business and momentum using wallet share gains and market share gains, and of course continue to invest in areas like the new verticals we seeded over the last few years, the new account acquisition engine, new client acquisition engine, and most importantly, capability build up using areas like AI, and of course making sure that we are able to expand our addressable market using that expansion.
The good part, Manish, is that and for you it's not been as big a problem as the industry, but the talent cost issue, the attrition issue, all of that seems to be behind. But there is a need for newer kind of talent for AI-fueled growth, so on and so forth, that Nitin was speaking about as well. How is that aspect of the business shaping up, not just in the quarter, but also for the last 12 months?
So clearly, acquisition of talent is one thing that Nitin talked about, whether it is through partnerships with partners like Core and WorkFusion, or it is through acquisitions like Silverline that we just did. However, even the bigger focus than that has been in creation of our own talent using platform that we have, which is Talent Next, using our whole approach towards compensation, where the GQ score drives the compensation, and GQ score is essentially how every team member upskill themselves and make sure that they are working on projects which are creating more value, both for the client as well as for themselves in future projects. So I think our dependence on or our lack of dependence on having to acquire that talent from the market also enables us to provide clients with staff with such special skills without necessarily having to charge them at the cost that you would otherwise incur if you have to hire them from the market. So clearly, the strategy to seed the teams with acquisition and then grow that through creation through the platform has been working well for us.
You are in this aspect of constantly giving quarterly appraisals, if I'm not wrong, because you've not timed it to a particular season from what I remember. How is that shaping up at this point of time when there may not be as big a need to do that? Though, of course, you always want to reward employees, but the attrition numbers have come off quite significantly. So therefore, the risk of losing employees left, right, center is kind of coming off a little bit.
So, adjusting to the market requirements was required when attrition really went up through the roof. But that does not mean that the compensation linked to performance and GQ score should be, kind of paused or terminated when the market is not that hot, because this is not dependent on how the attrition is. So I would say that we don't need to now do that special intervention that we were having to do when the market was really heated up. But anything and everything to do with compensating and rewarding team members as they upskill themselves and make themselves more valuable to the organization, that continues and that should continue.
Got it. Nitin, two-part question. The second one is on inorganic strategy, but the first one is a leaf out of the answer that you gave, that you are seeing some tough times into two of your key verticals. When they recover, does that or would that possibly give you the advantage of having not so tough a base to perform upon?
Yeah, I think, again, pure math basis, what you're saying is right. But I think the right thing to think about, at least from our perspective, what we watch like a hawk is the wallet share in every account, as well as the market share across the segment that we play in. If you think about banking, financial services, we believe we have a right to win in that segment. We've actually used the last few quarters of macro headwinds to actually strengthen our position in many of those accounts, especially the newer ones that we opened over the last 2 or 3 years. So as the spend recovers, I think we want to make sure that we continue to play that value-added service provider challenger role in these accounts where spend pockets are large. When competitor displacement is a big opportunity, and most importantly, as they start adopting some of the new technologies that we've seen emerge over the last few quarters, I think those spends will definitely help us gain a larger share of the wallet. So again, I think from a go-forward perspective, what will be, obviously, we want to make sure that we've paid the price for cyclical downturn. We want to make sure we gain from the upturn as the cycle turns. Whenever it turns, it's hard to call when, especially in areas that are sensitive to interest rates. But more importantly, we want to make sure that we are actually net gainers of wallet share and market share, because we are very, very focused on that segment and has been one of our oldest business verticals.
Okay, what about the other aspect, inorganic moves? Manish referred to Silverline as well, but of course, the whole strategy.
Yeah, I think if you see, we've had a very disciplined approach over the last 5 years of capability-based competency build-up through tuck-in acquisitions. Our first acquisition was almost 5 years ago, which was an AWS DevOps design consulting firm for banking in the US. That kind of became the foundation of a lot of what we do in the DevOps tribe, as well as in the AWS, and the hyperscaler ecosystem. The last one that we've done is Silverline, which is a Salesforce Summit partner, 400 plus consultants. Given the importance of the Salesforce ecosystem, as you think about the life cycle of a customer engagement model from most enterprises, I think that ecosystem is starting to gain a lot more traction, especially with playing in customer experience transformation, playing in an ecosystem where you can bundle conversational AI with Gen AI into the CRM-led application ecosystem and design capability through Blink. I think it's a very large opportunity that we think we should be able to monetize on as the transformation deals start building up there, especially supersizing those deals. Using even things like contact center transformation is a big play. So that's the thesis behind that acquisition. It was something that we've been trying to build up organically as well over the last few years, but this was a great asset with the accretion in capability, leadership accretive. Obviously, very strong partner at Salesforce, very deeply embedded with them, has a seat at the table from a product launch perspective, vertical cloud integration. So, capability-led acquisition, but obviously a lot of other things that come with it, including customers.
Got it. Manish, very quickly, we have 120 seconds. So second last question to you, 60-second answer. What do you feel about the second half? Any changes? Sorry, I haven't been able to look at it, but any changes to the statements that you have made about Q3 or the second half?
So the growth being back-ended and second half continues to be the commentary. There has been a delay in conversion of revenue versus what we were expecting, which makes the growth trajectory more fourth quarter than third quarter. However, third quarter should be positive. As Nitin mentioned, all the businesses are now in the positive zone. They have certainly bottomed out, and this is not based on macro, but this is based on the deal closures and the conversions that we are seeing on ground. And from a profitability perspective, we continue to be in that range with a northward bias. And as you know, we kind of reported an expanded margin this quarter as well at 15.5%. This obviously is excluding what the acquisition does to the profitability, but that we will come back to when we get to the next.
Makes sense. And Nitin, one final question. I've asked this to every CEO. Why is it that the TCVs looked good, but the revenue conversion isn't quite happening? Is it because of discretionary going down and the tenor of the deals being long, or what else?
I think it's a combination of everything you just said, Neeraj. There is a certain degree of discretionary spend cut, shorter duration, organic deal growth has been tighter. Scrutiny on spends has been higher. There is a digital dichotomy in play. On one hand, you're cutting discretionary spend. On the other hand, you're trying to find money to implement, Gen AI and AI solutions. So I think that reprioritization exercise hasn't really ended all year. We've seen some clients that have actually been on a monthly budgeting cycle, despite having a budget for the year when they started the year. So uncertainty creating inactions, definitely making that harder. Even once a deal is signed, there is a transition bubble cost issue. There is there are things that get scrutinized again from a spend perspective. So I think it's just been that higher scrutiny that is delaying some of this conversion from TCV to revenue. But I think the bigger issue also is the extreme amount of tightening of discretionary spend.
Got it. Gentlemen, you have a con call to do, so I'll leave you at that. Thank you so much for taking the time out. Manish, Nitin, really appreciate your time this morning.
Thanks, Neeraj. Talk to you soon.
Thank you. And viewers, thanks for tuning in.